So welcome to Investors Hangout brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. I'm Rachel from Value Research, and with me is our CEO, Dhirendra Kumar. So today we're going to be talking about asset allocation and having an asset allocation plan in place. Now, Dhirendra, why is it important to have an asset allocation plan, especially in the current scenario, and how does it help investors?
Asset allocation is crucial. It brings about some kind of stability to your portfolio. If you do not have any fixed income allocation, you will just be wildly riding the market, and sometimes it could be unnerving. More so in the early stages when you don't have experience. Anybody who started 1 or 2 years back with his SIPs, when you see all your accumulation on a free fall and it goes down by 20-30% in a matter of few days, it has the potential to scare you and drive you out of the market forever. So that's one. It brings about stability in your portfolio. The other is that it enforces a discipline. When you are working, when you have an asset allocation, a pre-stated asset allocation, whatever it be, whether it be 75% equity, 25% debt, you have 50% equity or 50% debt, it is a reference point. When your asset allocation gets completely out of whack, it is a prompt. It is actually a pointer that you need to do something about it, and need to do something about it in a disciplined way. Normally, if you have an asset allocation, and in normal times, it'll change a little bit. 50 become 52, or something become 48. Works in a narrow range. Don't do anything. But if it changes dramatically, do something about it. And do something about it is quite straightforward. Moving your money from one asset to another, it effectively amounts to buying low and selling high of an asset.
All right. And how should one decide on this allocation? Like, what should be the allocation to equity and what should be the allocation to debt? And also, how does one go about rebalancing the portfolio? Like the mechanics of it.
I don't think there is a thumb rule or there is a formula. But I think while you're in your initial stages of your, longer the time frame, have higher allocation to equity. I would say that 20% allocation to fixed income and 80% to equity for somebody who is very young, who still has 30-35 years to go. As you get closer to your retirement, take your allocation to equity to 50% equity, 50% debt. That should be fine. Because every year the market, at least every year sometime, the market goes crazy very often, and you will get that opportunity. Your act of rebalancing will enhance your return. You will also not lose your sleep, and as you get closer to your retirement, your need for relatively higher allocation to stable asset class goes up. So when you have more time, have smaller allocation to fixed income. As you get closer to, as you should be getting more conservative over time, take it up to 50%. And I think, the 50% equal allocation to both assets should be the target, even for the most conservative investor.
All right. So when somebody is rebalancing their portfolio, or say a portfolio of mutual funds, how do they decide on which mutual funds to, exit and, as they're rebalancing either from equity to debt or from debt to equity?
Assuming that, you're a very thoughtful investor and you end up with a small selection of 2-3 funds only, it's a very well organized portfolio and they are all winners. I'll tell you, the asset allocation rebalancing is not an easy thing, because it effectively amounts to selling your winners. And selling your winners is never easy. But assuming that you're a mature investor, over time you have narrowed down your investment to few investments, do it proportionately. I think the act of acting in a concerted way, in a methodical way, in a disciplined manner, do it proportionately. Otherwise, asset allocation or rebalancing can also be an opportunity to get rid of your losers. You have been thinking that this investment. So it entirely depends. If you have been thinking, or if you are getting unimpressed with some of your investments, maybe the rebalancing exercise can actually be an opportunity or could be a trigger to do it. Normally, we procrastinate with our investment actions, which has been held for a long period of time. Use rebalancing to clean up as well.
All right. And would the tax implication be a factor to consider during this rebalancing process?
Yes, there are two implications of, if you're a long-term investor and you have to rebalance, you don't have to worry much about capital gains, because there is a capital gains implication. You have to pay capital gains tax on your appreciation. But if you're an old investor, you don't have to worry much, because most of your investment will be held for long, and there is a 10% capital gains. So do the rebalancing only when the proportion, your allocation has changed dramatically. If there is a nominal change, you have decided on 50-50 allocation to equity and debt, and if it changes to 53% and 47%, don't bother. Normally, you should review it every year in normal conditions. And if it changes dramatically, maybe a 15% change from the pre-stated allocation, you should act, because that way you will be able to book profit, rebalance, and buying low and selling high will happen. One should be conscious of the capital gains, and there is a 10% capital gains tax applicable on your investment. You don't have to worry much about the exit load, because most of your investment will be held long enough that you have to worry about it.
So what about for somebody who struggles with the mathematics of doing the allocation? They know that they want to maintain either a 50-50 or a 30-70 allocation to equity and debt, but they struggle with doing that maths every year, or whenever the time comes for it. So is there an alternative for them, like a way they can get around doing this? Okay.
Yeah, absolutely. Set up your portfolio at Value Research. And while you are doing it, put all your investments together. Put your PPF, put your employee provident fund, put your fixed deposit, put your bonds, and put your equity fund portfolio, or even stocks if you hold directly. Value Research gives you the asset allocation with simplicity. Every day you can check it in the analysis view. What is your asset allocation? And that is the real asset allocation, because Value Research Portfolio Tracker is also taking into account the allocation of your balance fund. If you have invested in balance fund, doing it yourself might get a little tricky, but we are keeping a track of the asset allocation of the balance fund and how it proportionately affects your asset allocation. So track it at Value Research Online, set up your portfolio, and you will be able to keep an eye on your asset allocation, and that should act as a trigger. Very soon we will also have a mechanism of stating your asset allocation and ability to and you will be alerted when your asset allocation changes dramatically. That apart, assuming that you don't have this asset at Value Research Online, of course this is the easy and free way of getting it. You get your account statement from fund companies, the consolidated account statement. If you have a demat account, you will get a monthly statement from NSDL whenever you do your transaction. So total it up and take a look at it. You will have to do some calculations yourself, and you can do it on a plain piece, simple piece of paper. Add up all your fixed income investment, add up all your equity investments or equity related investment, and even if you do it roughly, that should be okay.
All right. So would investing in, say, a balanced fund or any other fund category also be one way to maintain that allocation? So which would be the fund categories which would already do that for you?
Yeah, there are investors who would not like to have this headache of keeping an eye on asset allocation or achieving the asset allocation, the desired asset allocation with simplicity. I've always thought that the hybrid funds are a great vehicle. If somebody has thought in terms of having a small asset allocation to equity, substantially into fixed income, and so for them the equity saving funds work very well. Unfortunately, the balance fund of the kind which I'm referring to, that people should have 50% allocation to equity and 50% allocation to fixed income, we don't have great mutual fund options there, because mutual funds somehow tilted towards every mutual fund which was erstwhile balance fund long time ago, mutual funds there used to be balance fund which was 50-50 into equity and debt, but because of the tax laws they keep tweaking their strategy, increasing allocation to equity, increased it to minimum of 65%, because tax laws were very favorable for equity fund, and to qualify as equity funds must have 65% allocation to equity. So they all became equity heavy. Now that category which is equity heavy is called hybrid aggressive, aggressive hybrid equity fund. That is also a nice way. I think the value of a hybrid aggressive hybrid fund is that you are getting far greater stability. You don't get the massive blow which whenever the market crumbles, and you are able to achieve equity return with far greater stability, automatic rebalancing, without worrying about the tax efficiency of a balanced fund. Assuming that you want to do 75% allocation to equity, 25% to debt yourself, you have to worry about the tax every time you do the transaction, but you don't have to worry about it when you're investing in the aggressive hybrid fund.
Right. Thanks, Dhiren. So we now move on to the questions which our viewers have sent us. So the first one comes from Jivan Dabra, and he asks, what kind of allocation would you suggest for gold and international funds in a portfolio?
I would look at them very differently. I look at gold as an insurance for your overall portfolio. Gold is the oldest asset which humanity has been used to as a store of value. I don't look at it as an investment. And I don't look at it as an investment because it is not an investment. It is only a store of value. And for some historical context or our traditions or culture, the value has gone up. But right now, the value is going up for a completely different reason, which is speculative. Also, because whenever there is, markets go in a tailspin, there is greater uncertainty. The whole world thinks that the world is coming to an end. Gold gets pricey, and from that standpoint, I think there should be an allocation to gold, but it should not be looked upon as an investment. It should be looked upon as a store of value, which will preserve the value in the worst of times. International equity, I look at it as purely as an equity investment, and I think it's an important equity allocation which investors should have, because we have our jobs here, we have our investments here, we have all our assets here, whether it be home or anything else. So having an investment which is not correlated to it is a good idea. The other thing is that there are great companies. We have our home bias. Most of our money and investments and our job or careers is domiciled here or is in India only. But there are great companies which you can invest with simplicity. And so I would look at it, and I can't really give an allocation. I think, the minimum allocation to gold for sake of insurance depends on the scale. It should be meaningful enough. At the same time, don't look at it as an investment. International allocation, I think it could be anywhere between 25 to 50% of your total investment, but it's still catching up. But today, with the kind of fund options available to investors in the country, it could well be easily 25% of your allocation, and the kind of investment options that you get while investing abroad is something which you don't get here. For example, the international fund, the US domiciled fund, or S&P 500 index fund which has been launched, or the Nasdaq 100, it's presenting a compelling option. We don't have the kind of businesses which you are able to access through these investments. So for investors who is, and I don't think it is adding risk to your portfolio. It is getting you greater diversification, enhances the quality of your portfolio, and it reduces your risk with that diversification.
So our next question is from Ankit Malik, and he asks, would you suggest dynamic asset allocation funds or multi-asset allocation funds, as they leave the asset allocation job to the fund manager?
No, the straight answer to this question is that no. I believe, my expectation from fund management is disciplined actions, diversification. If I have to put it in a certain order, I would say that, when I invest in a mutual fund, I look forward to convenience, I look forward to discipline, and I don't look forward to magic. I'm not expecting magic from them. And allocating this in a discretionary way is expecting magic. I'm expecting the fund manager to be heavily invested into equity at the right time, and not being invested in equity at all at the inopportune time, which I think is an impossible thing to do. That is why I support or I favor. But I expect from a fund manager that if he's running a balanced fund, or if he's running an aggressive hybrid equity fund, or he's running an equity savings fund, he will maintain the allocation at all times. He will not change the allocation dramatically, randomly. And that is what, that is exactly the opposite of a dynamic asset allocator, where the fund manager can go from 0 to 100% in equity or debt. One, they have not succeeded so far. In 10, 12 years or 15 years of their existence, I don't think they have been, fund managers have been able to successfully call the market well. The other is that the discipline itself. I would like to benefit from the discipline and tax efficiency of these allocations. If a fund manager is able to reduce the allocation, sell his equity and buy bonds to reduce his allocation to equity, which has gone up to 80%, that is good enough. I'll be happy with that, because that is more predictable. I will, just for greater predictability and rather predictable success of the strategy of enforcing an asset allocation seamlessly, I will not go for a dynamic asset allocation fund.
So Ravi Jain, he asks, while rebalancing a portfolio, how should one increase or decrease the allocation to equities in a systematic manner through SIPs, STPs, or in a lump sum?
When you are still in your accumulation phase, while you are still doing your SIPs, and you have decided to have an asset allocation or a pre-decided asset allocation, that 75% of your money is going into equity, 25% into debt, and if you have done it for 2-3 years, there is a likelihood that 75% allocation to equity would have turned into 80% or 90%, and the fixed income would have correspondingly got reduced. The simple way and a non-intrusive way or a tax-efficient way of doing it is, don't do your long-term SIP commitments. Revise it every year depending on the change in allocation. Assuming that you have decided to do a 75-25 and your equity has become 80. So increase your allocation, new investment allocation to fixed income to the tune that in a year's time, if you continue doing it with a steady pace of growth, the asset allocation will be reset to what you decided to. Don't act in a huff. Change this asset allocation in a huff, in a hurry. If this has changed dramatically, you decided to invest in equity to the tune of 75%. And because it has gone up dramatically, the fixed income has become 5% and your equity becomes 95. Realize some gains, move that money quickly. Don't wait to, don't think in terms of doing it methodically over the next 12 months or 15 months by way of changing your new investment to fixed income, because you will lose that opportunity. Whenever, rebalancing your allocation is the only methodical way in which you are able to sell high and buy low in a methodical way, which is prompted, which is guided by your plan and your investment, not on the fear and the greed that drives the market all the time. And something which we did not talk in the initial discussion is the biggest advantage of having an pre-stated asset allocation, and you're choosing to rebalance it whenever that changes dramatically, is that it's the only way, because people have a lot of regret when the market goes down dramatically without a notice, and it always does, or the market goes up, and the moment you are able to, if you take your money, you never have a plan, you never have a market contingency plan. Asset rebalancing is the only market contingency plan that you are able to sell and reset your allocation. The key advantage of rebalancing or having an asset allocation plan is it's your contingency plan. When market goes up and it falls dramatically sometimes, which it always does, then you have great regret. It reduces your regret. And assuming that, sometimes once in a while, if you're a relatively new investor, when the market falls, you get so scared that you sell and then you don't know when to come back again. We never have a plan that at what stage we will get back to the market again, or we will invest again if we pull out. So it does not derail your investment plan. It keeps your investment plan on track, and that turns out to be very comforting thing for most investors.
All right. So Subhash asks, what kind of asset allocation and rebalancing would you suggest in the current scenario? I am only a few years away from retirement and have been investing in equity mutual funds for more than 15 years.
As Subhash is approaching his retirement, I think he should target a 50% allocation to equity, 50% to debt. But he should be conscious of one more thing. When he retires, he should think in terms of creating a 3 years income that he needs to consume. He should take that money off from his long-term allocation, because that is something which will free him from worrying about his investments on a day-to-day basis. He will be assured that 3 months income requirement is kept aside. Remaining money should be 50% equity, 50% debt. It is easy to implement. It also creates a greater opportunity of rebalancing, and it will give him all the comfort in terms of half of his asset will not be on a meltdown whenever the market misbehaves, or and it always does.
All right. All right. So P. Rajagopalan, he asks, in the present COVID crisis, would you suggest stopping SIPs for long-term goals and instead stepping up the contingency fund?
This is entirely a personal question. It entirely depends on your personal circumstances. If you have lost your job,
right.
You have to. Your circumstances change, so should your investment plan. You had thought that so if your need for having that emergency fund is higher, you are beginning to appreciate that these are abnormal. This is not the normal conditions. It's the restoration of the normal conditions to which we were used to in terms of work, income, and spending. You should. But just because there is a crisis all around and everything else is in place, if your income is still intact, your spending has come down a little bit, but simply because you are more worried, think about it. You never had an emergency fund, you never had that contingency fund. Be a little liberal about it, but don't disrupt your SIP just for the heck of it, because the world seems to be a little more scary.
All right. All right, so the next question is from Samir Deshpande, and he says, I have invested in the voluntary retirement scheme recently. Should I continue with my Provident Fund account, or should I withdraw it and invest it elsewhere?
You have taken voluntary retirement, that money can lie there, but after a year, it will become taxable. The income from your Provident Fund becomes taxable if the contribution stops there. So if it is the EPF account, so you will have to worry about it in terms of taking it out. The advantage of the EPF account is that all the return on that is completely tax-free, but only till a year of your, otherwise, if the contribution stops there, it becomes taxable. So you should think in terms of moving that away, and then work on an investment plan. Watch out, look for all the content that we have here, all the videos that we have here. There will be many of the writings, many stories here, which will help you formulate your plan, and then consult a investment advisor to implement, or maybe try your hand yourself. But do it with confidence, do it with understanding. You will have to move your money from EPF to generic investment to plan your taxes better.
All right, so we're going to just take one more question. This one is from Vijay KN, and he asks, how many funds would you recommend within each category for proper diversification? I have a few crores invested across large cap, multi cap, mid cap, balanced, liquid, and short duration funds.
Leaving aside the fixed income funds, the short duration fund, which I think is a good way in these times. Make sure that the credit quality of the underlying portfolio is not very risky. I would say that there are different approach to dealing with it. I would say that 2 or 3 multi-cap fund is good enough. That is one approach. The other is that having 2 or 3 balanced fund is also good enough. In fact, in the simplest form, 2 or 3 balanced fund. When I'm referring to balanced fund, I'm referring to they are actually not balanced fund. They are the aggressive hybrid funds I'm referring to. That is also good enough. It eliminates the need to have that short-term fund or equity funds differently. But you may not get too many options. Then so the simplest plan will be aggressive hybrid funds, 2, 3 of them. The second one option will be having a set of multi-cap fund, and 1 or 2 fixed income fund. The third option will be, having a combination of multi-cap fund and 1 or 2 small cap and mid cap fund. But I think having more than 4 or 5 funds nullifies the whole objective of investing in an equity fund. One, they become unmanageable. The other, the more your portfolio is spread, you tend, your underlying portfolio tends to be an index fund, and you are paying the money, you are paying the fee of an actively managed fund. Third is that, when your portfolio becomes very fragmented, you lose interest. The funds which don't do well, you say, well, there's not much money is invested there. When they do well,
Right.
it does not have. If some of your funds do very well, they do not have a proportionate impact on your overall portfolio. So I would say that don't have more than 4 or 5 funds. That's good enough, because those funds are actually owning 30, 40, 50 stocks. Despite the overlap of the different funds that you own, you will, with 4 or 5 funds, your underlying portfolio could well be of about 200 to 250 stocks. That is good enough.
Right. All right. Thank you, Dhiren, for answering these questions. For those of you who are watching, do continue to tune in, and please continue to send in your questions as well.